Hey folks, Dan Frio here with your Mortgage Minute. Today we're going to talk about the Fed, inflation, and housing, because the two biggest questions I get all the time, and you guys might have these same questions, is, Dan, when are we going to see the housing crash? Because we know it's coming. And where are mortgage rates going to be from now? Because if they keep going the same pace that they've been going so far this year, they're probably going to be at 9 or 10%. Well, let me put you a little bit at ease at some of this information. So what I want to talk about today is what the Federal Reserve is doing and how those effects are taking its toll on the markets right now. So let's get to it. The Federal Reserve right now is saying, or the New York Times, is saying strong wage and job growth keeps the Federal Reserve on track for big rate increases. Why did they say big rate increases? Because the Federal Reserve came out at the last meeting and raised rates 0.75%. They haven't done that in decades. Their expectations are, and they told us last time, that when they have their next meeting, they're going to do the same thing. Well, their next meeting is coming up just about 10 or 15 days from now. So we expect the Federal Reserve to raise rates another 0.75%. Are these rate increases helping? Well, the next piece of the puzzle we have here is one area that is really starting to slow down the economy in is Fed rate hikes have calmed down the competitiveness in the housing market. Okay, so what I do every week or every day, I try to come out and give you guys the information on what's going on in the markets that's going to play a role in housing, especially on the financing piece with mortgage rates. Okay, so that being said, I focus in on the Federal Reserve and inflation, because those are the biggest things right now that play a role in everything. So we know the Federal Reserve is raising rates. We know that the Federal Reserve rate hikes are starting to hit the housing market, but what's some other information that might help or hinder the housing market or the overall markets in general? Let's get to those. On the energy side of the equation, which was the biggest mover in the inflation gauges in the last few readings, is oil. Okay, so what's oil doing right now? You can see right behind me, oil is starting to slide. It's plummeting. Natural gas is in a bear market. So what's going to happen there? Well, here's what's going to happen in the next consumer price index readings. The numbers are going to be crazy high. Okay, why? Well, there's always, that number is a lagging indicator, meaning the data that we have now is data from last month or last 30 to 45 days. Well, the biggest reason why I think this number is going to be explosive is gas prices. Gas prices really weren't at their peak until about 3-4 weeks ago. That'll be in this month's reading. So expect the inflation readings for this month to blow out the charts. So what's going to be the initial reaction on Wall Street and the other pieces of the market? Their knees will buckle just a little bit until they realize, oh, wait a second. It's based on gas prices and oil prices being way up, but they've come way back down. So our next reading should actually show inflation in the energy sector starting to come back dramatically. Also headlines today is inflation fatigue. Bond investors latch on to disinflation. So what the bond market's telling us right now is right down here. The bond market is pricing in a steep deceleration in inflation over the next year as aggressive rate tightenings by the Fed will start slowing down the economy, thus keeping us in a recession for a shorter period of time, maybe even avoiding a recession. Don't know. Okay, so based on all this information, what is on the economic calendar for this week that we should really pay attention to? I know I'm going to be. So the first piece of this is today we basically have nothing. Monday, Tuesday we have nothing, but then on Wednesday the data starts to flow, and this is when the market's going to get really volatile. On Wednesday, we have the core CPI and the CPI number, consumer prices, what's going on there. You're going to see that number is going to be big, and it might be bigger than a lot of people think. Again, why? Is because prices peaked during this time frame that they're analyzing. They're starting to come back down now. So again, until people realize the data is basically data in our rearview mirror, not on our windshield, there's probably going to be a knee-jerk reaction in the markets. The other piece of this puzzle is crude oil inventories. We see that here. The more inventory we have, thus supply demand, if the inventory increases and let's just say demand stays stable, it should bring down prices. So I'm expecting the oil prices and gas prices to start really coming back right now, but it depends on what happens in Russia and Ukraine in that area. Then we see on Thursday, we have the jobs numbers. That's right here. And we have the producer price index. So we have a lot of inflationary gauges this week and a lot of jobs information. And then on Friday, we have core retail sales and retail sales. So the reason why I bring up this calendar is I like to follow, and like I just said, I like to follow what the Fed's doing. The Federal Reserve has two mandates. They are there to create full employment, or help out as much as they can there, and price stability, aka inflation. So if we see the calendar for this week, you're going to see that's right in the Federal Reserve's wheelhouse. Inflation, energy, jobs. Okay, so the jobs market and the energy market and the credit markets. So based on all this, what in the heck's going on with mortgage rates? Well, we're having a good day so far. Let me explain this chart to you. So this is what's going on with the MBS market. It's the bond that trades on Wall Street. That's yield is the biggest component of your mortgage rate. That's the best way I'll say it. This is what's going on to the price of the bond right in here. As this price goes up, your mortgage rates come down. It has a flip-flop relationship. So let's look at it this way. If you're looking at this chart and it's going down, that's not good, because that's not the rate, it's the price. As the price goes down, you're going to see rates going up. We love when this number is plus. We don't have a lot of that, as you can see in this chart, but down below, we've had a little bit of stagnation down there over the last week or two, which I'm loving it because I like stability, as well as I'm assuming you would like that too. So based on all this, what's going on with mortgage rates? Well, here's where mortgage rates ended on Friday, because Mortgage News Daily has not posted it yet today. I said on Friday, rates are going to go up. They'll probably go up about 0.05 to 0.10, and I was right in that wheelhouse. So this is mortgage rates published by Mortgage News Daily. The reason why I post this is, one, it's very easy to read, as you can see here. It gives you the trends for the day, what's going on. We have a great day on store for us right now, and the MBS market is up 30 something, as you know, we just went over. But down here, the trend is good, and here's the 10-year chart. We know that's ugly right now. So let me explain this chart for you and why I like to show this. I'm not necessarily wanting you to focus in on the rate, which the rate is a national average. The rate is subject or based on an 80% loan to value, meaning somebody's buying a house, putting 20% down, a 740 credit score. They're buying their primary home on a 30-year fixed rate, or whatever terms are on here. The reason, again, why I show these numbers here is not to really look at the rate, but the adjustments. And my thinking behind all this is, if you have a portfolio that's fairly big, you can't really check every stock every day. Well, you can, but one simple way to do it is, what's going on in the Dow Jones? The Dow Jones is up today, or the NASDAQ's up today, so my stocks are probably up today. It's a simple way to look at it. So if you're looking at a 30-year fixed, and you got a quote recently, and they quoted you, 5.5, but you didn't lock in, and you sat on the sidelines. Now you're watching my video. What happened to your rate? Well, most likely, if you can see behind me or right in the screen, is that rate went up 0.11%. So your rate, if you didn't lock in on Thursday, your rate Friday probably went up 1/8%. So that's what I want you to focus in on, the adjustments, what the changes are in the rates. So that's my report for today. My name is Dan Frio. I am a mortgage advisor. My team and I are federally chartered now. Meaning, what does that mean to you guys? Anywhere in the country, we can help you. So if you're in Minnesota and you're in Wyoming, or you're in Idaho or Florida, California, anywhere out in the country, we would love to help. If you're out there, you're building a house, or you're looking to buy a house, we got great programs for you in regards to that. If you're building a house, we have rate extensions up to 6 months. If you're looking to buy a house and you're shopping and you just can't find something, but you're really stressed out because, oh my goodness, what's going on with mortgage rates? I can't afford to buy that house if rates keep going up. What can I do? Why don't you lock and shop? We have a program called Lock and Shop. We lock you in today while you're shopping. So you know the rate prematurely before you even go out in the markets. You know that rate isn't going to move. So if you'd like to find out more about that program, our extended lock program, and much more, please reach out to us. Our information is right above. You can give us a call, schedule a meeting. You can even chat with us over here. That's my report for the day. God bless. Thanks for watching. Please don't forget to give us a thumbs up, subscribe down below, hit the bell every time I post a video. You get an alert. Take care, guys. See you soon. Bye-bye.